there's less incentive to build new properties. And in some respects, a lot of the market is going through this now. It's cheaper to buy existing than it is to buy brand new. So a lot of developers can't feasibly create brand new real estate. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into some of the context around new construction versus existing property. It's always a little bit of a debate when it comes to what is best from a property investor's perspective. So I want to go over it because there is some mathematics behind it all. There is some economic theories behind it all. I think it's a worthy discussion on the Urban Property Investor podcast. But hey, welcome back, regulars. You know the drill. Play the program in double speed, get your life back. And of course, all the episodes I've done are actually lessons on real estate. So feel free to go back in time. But hey, life is good. I just rescued a possum. Yes, a little baby possum. Can you believe it? In New Zealand, I was just in New Zealand, and New Zealanders wear possums as headscarves. They make little jackets out of possums. They really hate possums in New Zealand. But here in Australia, the possum is a little protected species despite living in your roof. And I found little Oswald, I called him. Yes, Oswald was found. He was crying for his mother, but we couldn't find his mother. Anyway, I rang Wise. Wise has just been over. What a service. The volunteer service of Wise. So today's shout out is to, I guess, those that volunteer at Wise looking after Australian national animals. They came and last night at 11 o'clock in the evening, we went back to the tree I found the baby at, and guess what? The baby was reignited with its mother. So it's a happy ending for Oswald, the baby possum. And just had Wise around here. They were returning the little cage I gave them. Yeah, we saved Oswald. But hey, let's talk about saving ourselves when it comes to real estate investment. Obviously, there are some factors that pertain to real estate investing, whether it's investment purpose, the investment time horizon, the expected cash flows of the real estate, the expected profit or opportunity of the real estate, valuations and what's going on in the lending and leverage space, the overall real estate market, what's happening in the cycle, property locations, what's driving the local factors and the rate of growth. And of course, in all of that, there's you, the property investor, where you're at with your leverage, what you can borrow, where you can borrow, how much you can borrow, and over and above that, then there's the type of dwellings available in Australia. And of course, Australia is a country of new immigrants. And as such, there is always a robust level of new construction in Australia, whether it be in new urban growth zones or whether it be in infill locations where there's gentrification unfolding. There's existing properties that compete with new properties. And of course, there is always a conversation around the concept between the two. Now, just so we know, new real estate is not necessarily a niche thing, though it's often described as a niche thing. A few people, dabble in new real estate. It's around 30% of the market. 30% of real estate buyers every given year are doing a new build, whether that's a knockdown rebuild, whether that's a part of a urban growth zone sector, or whether it's just a new property that's being produced. So effectively, around 30% of the market is doing that. So sort of 1.1 in 3 1 in 3.5 buyers are basically choosing to do new real estate. So it's not, a niche little thing. It's huge here in Australia. And primarily it's huge because Australia is a growing country and fails to constantly keep up with its growth plans through migration versus housing. The majority of people that buy real estate, really 2 out of 3, do buy established properties, existing homes that are traded and retraded and traded again. So there are kind of 2 marketplaces at work at any one time in Australia when it comes to real estate: the new construction market and the established marketplace. And of course, when it comes to understanding strategy around both established real estate and new construction, there's kind of 2 real models that link to strategy. Now, what is not a strategy is just investing without a framework, just buying a property. Strategy in real estate is often linked around the purchasing process, the add value point of the real estate. And this is where we need to understand property lifecycle theory, the idea that real estate is created brand new and eventually it goes into a period of rapid decline. And really, the property can't be saved. It needs to be knocked down. Now, that time frame can be 50 odd years, but during that time frame, there are renovation points to a piece of real estate. And of course, renovation is a great add value strategy. There are also points in the process where the home is too costly to renovate, so a knockdown is actually a better strategy to do, a knockdown rebuild. And so property lifecycle theory kind of determines that there are sort of 4 quadrants to the life cycle of a property. There's the new construction part, which is typically the best way that you would buy in new construction, is potentially get a discount on something brand new that a developer's been caught with. And of course, developers are commercial, so they, are less emotional about adjusting price. You can develop your own brand new real estate by becoming a property developer or part of a joint venture and develop with other people. You can build. You can buy a block of land and you can build on it, whether it's infill, next fill, or greenfield. And of course, you can buy off the plan from a developer. Now, there are points in the cycle where all of those strategies make sense, from off the plan to building to developing. And there are points in the property cycle where they don't make sense, where if you bought pre-construction off the plan, you're going to lose money because the market is not designed for it to work by virtue of concepts which I'll discuss. Equally, at the end of the property's life cycle, when it's really deteriorated and in rapid decline, some good opportunities to renovate, but also sometimes renovation doesn't work. The math don't math. Now, in between the 4 stages, the first stage is introduction, the last stage is decline. You've got 2 other stages where effectively the real estate is seen from a life cycle perspective as growing and mature. It's just a good practical piece of real estate with no flaws to it. Now, when it comes to new versus old, there's always these conversations where, people will sort of talk about the idea of, well, one asset's better than the other. Now, I just say, look, there's no real benefit to either, in the context that you buy real estate based on its capital growth and cash flow, its total return logic. If it's old real estate, that's fine. If it's new real estate, that's fine. It's just the way it is. But you need to consider that real estate is driven around its location. So if you went to a heritage suburb where every house is 150 years old and that's the look and feel of the neighborhood, typically you would want to buy a heritage property, which is an older property. You may want to renovate it with some modern features, but effectively, you could never really create a reason to buy new when you're in a heritage marketplace. Same with character marketplaces where there's beautiful old character homes. That's where the value is at. And of course, you're probably better off going for that marketplace from an archetype perspective when it comes to location, when it comes to just sticking to character housing. But character housing is not inexpensive. You're well over 1.5 million for most neighborhoods in Australia that offer character housing. So again, like if you're an entry-level investor, you may not actually do well out of character housing by virtue as you just simply can't afford to buy it. Same with heritage. And of course, aspirational suburbs where people aspire to live are well and truly over $1 million plus in society today. And again, like from a secondhand established point of view, they're usually great places to invest, but there is no new versus old argument because for the most part, people who can afford aspirational suburbs, 1.3, 1.4, 1.5, would probably be reliant upon the existing stock levels in that neighborhood. Now, this is where new versus old starts to be a conversation piece when you start to go down the rankings of locations. As I said, like heritage, character, and aspirational, you're better off buying secondhand if you can get into those marketplaces. Where you start to fall into the trap of secondhand versus new starts to be a bit of a conversation piece is suburb archetypes like disadvantaged suburbia where, most socioeconomics is pretty troublesome. You probably wouldn't want to buy there just because it's established real estate, just because it's cheap. Socioeconomics and the challenges behind it is not a great way to make money out of real estate. I don't know too many people who've become extremely wealthy out of buying basically in the broke end of town. Sure, some people can acquire some assets, but at the end of the day, you're buying in the worst suburb in society. And of course, there is little proof or evidence that it goes on to making people extremely wealthy out of real estate. Same with broken suburbia. Broken suburbia is like you drive down the street and you can see that every house looks different. There's graffiti everywhere. There's some shopping trolley, thrown onto the road. The main roads are busy and noisy, and you're very much disconnected from socioeconomics that is improving that neighborhood. So we can say it's probably better to buy established in heritage, aspirational, and character, but it's not necessarily a good idea to go to the broken end of town and disadvantaged end of town and just buy old real estate, because the potential to renovate it and overcapitalize in a marketplace which is a bit downtrodden is always challenging. Meaning if you buy the real estate, you could be holding it for a very long time whilst the actual physical structure declines. And of course, you're not getting any more rent. You can't renovate because there is a limited amount of value put into your property through your neighbors uplifting their property, knockdown rebuilds, renovations. It's just not happening. However, if you go to the heritage, aspirational, and character markets, what you'll find is continuous renovation of those neighborhoods. And that's where the strategy buy, renovate, rent, recycle works very, very well. The other strategy, as opposed to buy, renovate, rent, recycle, is buy, depreciate, rent, recycle. And this is where new real estate can be rewarding as an investment strategy. And that is where I would highlight buying new real estate in what is known as renewal suburbs or future suburbia. areas which tend to be in urban growth zone neighborhoods, they gentrify quite quickly. And the reason they gentrify quite quickly is everyone in the neighborhood is building a brand new home. Every stage, there's price improvement. And you get this kind of like not house by house renovation. You get effectively a suburb renovating itself very, very quickly. And again, like for new construction, you wouldn't want new construction in broken suburbia or disadvantaged suburbia. It wouldn't make sense. And there's plenty of new construction, market lemons, in suburbs which are just pretty ordinary neighborhoods. And again, the delta, the price difference is just like, it's just wrong to begin with. And it's just a wrong investment, whether you're buying old or new. However, there are pockets inside of our suburb archetypes where effectively new properties do very, very well, and you would buy new if you wanted to get behind that strategy. Now, old properties tend to, in established neighborhoods, those character suburbs, they've got some benefits to them. Quite often they've got more land, they're in central locations, and they can be, quite character in their design. New properties tend to be energy efficient, well built in the context that they're going to give you 50 years of ownership without too many problems. It's obviously less maintenance, and they're less expensive to run when it comes to their look and feel. Now, some of the best ways to actually buy new real estate is to blend old established suburbs with character with new real estate. And this is where you get a lot of that knockdown rebuild happening in those aspirational suburbs, character suburbs, and even heritage suburbs, where there's just an opportunity to reboot with brand new. You can often find a premium paid in those neighborhoods for the new real estate. So when it comes to new versus old and all that kind of stuff, really there's just two strategies: buy, renovate, rent, recycle, which is a great strategy, and there's buy, depreciate, rent, recycle. There's really no right or wrong. There just kind of is. And you really, if you are buying new, you just want to make sure that it's new for a reason, and it stands out, and it's actually going to grow in value as a new addition to a marketplace. Quite often, I like new properties in, the right sort of growth zone, and also the right gentrification zone. You can do pretty well out of it. Now, there is a concept to understand how real estate works known as Tobin's Q theory. It's a theory around valuing assets in economics and investments. And it was defined by a guy called James Tobin. He was a Nobel laureate. I actually served in the Robert F. Kennedy administration, President Kennedy. So he's a pretty formidable economist when it comes to his thoughts around how to understand economics, and really the idea of Q theory or Tobin's Q theory really pertains to new versus old real estate as well. And so Tobin's Q compares an asset's market value with its replacement cost. And probably the best way to understand it is both linked to the market dynamic as well as an actual deal. So if it's cheaper to build new assets than invest in established assets, you're obviously going to get a period of high supply. Developers will push new supply into the marketplace. And there has been periods where that has been the case. If it's cheaper to buy existing assets, there's less incentive to build new properties. And in some respects, a lot of the market is going through this now. It's cheaper to buy existing than it is to buy brand new. So a lot of developers can't feasibly create brand new real estate. And market value equalizers, where you've got this kind of replacement cost equals equilibrium, the cost of buying established property plus renovation on the old property is equal to a new property. That is equilibrium. Now, one of the biggest mistakes property investors make when it comes to just choosing established property is not assuming capital costs. So someone might buy a 40-year-old property. It needs 200 grand spent on it, but because the price online is, whatever, they just buy off price, but don't factor in, well, you just bought a property for $800,000. It needs $300,000 spent on it. So with your stamp duty, you're actually buying a $1.2 million property. However, they don't rationalize that because they've just looked at the price and gone, well, that's my budget. I'm going to buy that and I'm just going to hold on, see what happens. But as we know, when you hold on to a property which is full of costs, it starts to be a back pocket thief. So the true calculation behind Tobin's Q theory is the cost of the property plus the renovation equals the cost of equilibrium. So then you can discern whether a new build is actually close to an older property once you account for capital improvement costs. So the real comparison for old stock is market value plus renovation cost versus replacement cost of new build. This is where you get this kind of equilibrium dance where sometimes it's better to buy new versus old once you factor in capital improvements. And sometimes it's not. Sometimes even with capital improvements, there's margin against brand new. Australian real estate is very much pegged to brand new real estate. And the reason, as I alluded to, Australia is an immigration-bound country. So we're always going to be building new properties. It's just the way it is. And so, I can give you a sort of an example. Let's say, just using some easy maths, a new house was $500,000, an old house was $400,000. The renovation cost of a $400,000 property plus 50 grand took you up to a modern spec. The total to buy and renovate is $450,000. That is cheaper than a new build. Effectively, the renovation makes sense. If the renovation cost, though, on the $400,000 property blew out to $120,000, you're now at $520,000. The replacement cost of the new property is only $500,000. So effectively, you would have been just better off buying new. So investors can watch this gap. It's called the Q theory gap, or James Tobin's Q theory, however you want to remember it. But it's something that I study a lot. I use this every day in my work, in what I do. And so recently, some new construction, for example, apartments, just don't make sense compared to buying old and renovating. Like, they just don't make sense. You'd be better off buying old and renovating. However, some houses, you'll be better off buying brand new and just getting rid of the old house because you could not actually renovate it to the standard of a new property. So it happens every day. It's out in the real world of negotiating real estate. So just understand, new builds kind of set a ceiling. That's kind of the logic behind new construction. It's kind of always, typically sets a new benchmark. Older properties naturally sit below that benchmark. That's really natural. It's like just the way it is. And renovation and development of the old property needs to be factored in to push up to the new ceiling. Now, there are always, some anomalies: location, land scarcity, zoning, etc. And of course, the market can be very irrational at times and behave irrationally. So quite often, some things just don't make sense. So, for example, like the brand value of a certain home builder is more valuable than another home builder. And so, a home with no brand versus a home with a brand, it's hard to rationalize what that can be as well. So replacement costs can be a little bit tricky to measure, but just on a delta price differential, it's probably the easiest way to do it. Now, quite often with new versus old, there's always logic around like, okay, well, how does the maths actually even work? So this is where we have to consider what is known as really the 4 drivers of total return. Now, I've talked about total return a lot, which is really the idea that you can, you've got to factor in your capital growth rate for the real estate and your rental yield, and really you've got total return. But there are drivers behind those 2 scenarios of total return. One is the income, how quickly you can produce income, but also what is the ability for the rents to grow in the future on the asset. So income production, equity production, what is the ability for the real estate to grow into the future? Finance, what it costs to buy, and taxation, what you can claim from the asset. And so really that framework allows you to work out your total return. So if you've got a modern property which has got a good yield, but the rental growth on the yield is going to be superior, you've got to be able to forecast that. And why would it be superior? Well, it's just a more modern place. If you've got an older property, you might have to adjust to get a higher return at the point of purchase, or a higher yield at the point of purchase, because the likelihood of the yields going up when the asset is diminishing is kind of low. Like, who wants to pay more for a property where the toilet's constantly leaking? So you've got to be able to do some mathematical kind of, look into the framework of a total return. And really, in some respects, when it comes to the cash flow position, new builds can actually outperform older properties through a stronger starting rent and tax advantages. And so just from a cash flow position, quite often they can outperform unless you're buying the old real estate at a bit of a discount to push the yield up. But when you measure it, it really depends on your time horizon and what you're measuring the maths. A lot of people just measure the maths on the day of purchase, but don't forecast what next. Okay, so a nice modern property, is the rent growth going to be better than a property deteriorating? Well, yes, one could conclude that is usually the practicality of it. And of course, tax income is another conversation piece. Now, here in Australia, there's depreciation, Div 43 and Div 40, plant and equipment, and capital works allowance on new real estate. If the real estate is older than, say, 1986, it gets no Div 43 and no Div 40. And so if you were buying a 50-year-old property, it's not going to have depreciation in it. It's just not. If it was renovated, substantially, maybe you would get a little bit of, if the building was renovated, but then you're talking about, well, it's half new. So then again, if it's purely just not a new property and it's an older property before 1986, you're not getting any depreciation. And so your yield has to work a lot harder because you're not getting the basically benefits of cash flow, which you can claim weekly through a PAYG variation coming back into your back pocket. So you've got to work out like how much throttle this asset's going to get. And of course, the practical realities is if you've got a good starting rent, better rental growth, depreciation, and lower repairs, well, your total return on investment is going to be a lot higher down the track. And of course, that's the trade-off. That's the trade-off of buying old. When you buy old, your trade-off is usually your cash flow. So you're going to need higher capital growth on the older property. And so the higher capital growth on the older property needs to outgrow the rental stability on the new property. And that's the balancing act of the two. And so this is where quite often, people will talk about land to asset ratio on an investment. And, I'm on record saying one of the best ways to do it is just 50-50. 50% land value, which will get you your growth, 50% building value, which effectively means that you've got a pretty solid structure there producing you rent. It's pretty modern. It's doing its thing. However, a lot of people in investment prefer a really old property and a lot of land value because the land is what grows. But the older property, the missing dialogue in that conversation, doesn't yield as much. And so you've got trade-offs. That's just the way it is. So hence why a lot of people who buy old renovate to new. Why? Because then they fix the yield. Then they fix the yield conversation. And again, the capital cost rule, it's an important rule. It's an important rule. So again, if you were to have a property, let's say they were pretty similar, one was new, one was old, they've got the ability to score the same amount of capital growth. Let's just play devil's advocate. They both are in really good locations, both in exceptional growth positions from a capital growth perspective. Let's assume they can both get a rock star capital growth rate year on year at around 7%, but the new property gets a higher rental growth rate and a better starting rent. Then really the older property has got to play catch up constantly, and it doesn't need a 7% growth rate. It needs a different starting growth rate. It needs 9.6% growth rate. Why? Because the yield or the total return and lack of depreciation is missing. So it's going to need more capital growth to do the same thing, or it's going to need a higher rental growth rate to do the same thing, or it's going to need a higher starting rent to do the same thing. And so this is the internal rate of return, which is effectively the return on investment expected to generate over the life cycle of the asset, which accounts for the cash flows and also the growth. And so you want to sort of forecast about 15 years. It's really where I think real estate is time bound to. And again, like, you can get an older property to do a great level of internal rate of return, but you may just have to pay a lot less for it to push the yield up to then balance out its projections. And so this is why older properties quite often are more about renovation upside than just buying a cheap property in a property life cycle and just watching it rot. It's really not a strategy. That's just not. But you can certainly buy a renovated property, which is effectively you will be paying for that. That will be built into the price. You can buy a new property, a renovated property, or an unrenovated property, or you can just buy a property which is tied. And if you leave it alone, that's probably the one angle which, can be challenging for property investors. It's just, you're not dealing with the problem. Real estate is all about dealing with problems. All right, folks, that's it from me. I don't know if we cracked that code, but we certainly talked a bit about it, didn't we? But yeah, what strategy is right for you? Buy, depreciate, rent, recycle, or is it buy, renovate, rent, recycle? Great strategies, just don't sit in the middle where there is no strategy. All right, that's it from me. Take care. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.